Let's be honest for a second. When you picture a successful investor, what pops into your head? For a lot of people, it's a mess of charts, blinking numbers, breaking news alerts, a whole lot of stress, right? The common wisdom is that to win, you have to be smarter and faster than everyone else.
So, on one side, you have that world of complex trading. It's high stress, it's often packed with high fees, and this leads us to a really radical question. What if all that crazy effort is not just a waste of time, but is actually holding you back? What if the real secret to long-term success isn't about picking the right stocks, but choosing not to pick them at all?
Okay, so let's fix that. In this explainer, we're going to build a clear, long-term investment plan from the ground up. First, we'll get into the core philosophy of simple investing. Then, I'm going to give you 5 portfolio models you can use right away. And, most importantly, we're going to see how they actually held up over the last 10 years.
The whole philosophy hinges on one big mental shift. Stop trying to find the single magic needle in the haystack. Instead, just buy the whole haystack. We're getting out of the game of picking individual winners and just owning the entire system.
And the tool that makes this all possible is the Exchange Traded Fund, or ETF. The easiest way to think about it is like this. Instead of going to the store to buy one apple, you buy a pre-made basket of fruit that has hundreds, sometimes thousands of different companies inside, all in one shot. And the best part, the fees, called expense ratios, are incredibly low.
This really shows you the power of diversification. You know, betting everything on one single company is super risky. If it fails, you lose. But if you expand to the S&P 500, you've got the 500 biggest US companies. Much safer. But why stop there? When you own the entire global market, you own thousands of companies all over the world. You're not betting on one company anymore. You're betting on the long-term growth of the whole global economy.
And this, right here, changes everything. Your goal completely shifts. You're no longer trying to outsmart the market, you just want to be the market. Your success is tied to human innovation, to global business, to technology moving forward over the long haul.
So, stay to the end and see 5 bonus high-growth sector ETFs driving the future of the global economy.
So now that we've got the why covered, let's get into the fun part, the how. We're going to look at the actual building blocks for these portfolios. I like to think of them in 2 groups. You've got your core foundation, and then you have what I call amplifiers that let you tweak your strategy.
Okay, so the foundation of any of these simple portfolios is a big, broad market ETF. The 3 heavy hitters cover different ground. VOO gets you the 500 biggest US companies, VTI gets you the entire US market, and VT gets you the whole world. Honestly, for a lot of people, just picking one of these is a fantastic, complete portfolio. Now, once that foundation is in place, you can add these amplifier ETFs, which are kind of like control dials. Want to lean into higher growth? You can add a tech-heavy fund like QQQ. Need some income? A dividend ETF like SCHD is perfect. You can even add real estate for a hedge against inflation, or a low volatility fund if you just want a less bumpy ride.
All right, let's put it all together. We're going to take these core and amplifier building blocks and build 5 dead simple set and forget models. The kind of portfolios that long-term investors have been using for decades to quietly build wealth.
First up is the absolute simplest, the one ETF portfolio. It's just VT, the Vanguard Total World Stock Fund. That's it. With this one purchase, you own a tiny piece of thousands of companies all around the world. It's the ultimate benchmark for just pure, simple diversification.
Next up is a legend, the classic Boglehead portfolio. Named after the great John Bogle, this is the gold standard. It combines the total US market with the international market and then adds a small slice of bonds. The thinking is brilliant. The stocks are your growth engine, and the bonds are like a shock absorber to make the ride smoother, especially when the market gets rocky.
Now, if you're someone who's willing to take on a little more risk for the chance at higher returns, there's the Growth Tilt portfolio. It's got a strong S&P 500 base, but then it adds a big tilt towards tech stocks with QQQ. The trade-off here is pretty clear. You're betting that tech will keep crushing it, which could mean much higher growth, but also much bigger swings up and down. I really like this model. It's a true wealth builder because it balances market growth from the S&P 500 with assets that actually generate income. You get cash flow from the dividend stocks in SCHD and a nice inflation hedge from the real estate in VNQ. It's really built for both growth and income. And finally, we've got a more defensive play. The low volatility wealth builder is for anyone who just hates seeing their account balance take a nosedive. By adding dividend stocks, low volatility stocks, and bonds,
It's designed to smooth out the journey and soften the blow of big market crashes, all while still capturing really solid long-term growth.
So these all sound great in theory, right? But here's the billion-dollar question. Did any of this stuff actually work in the real world? Well, let's put them to the test and look at the data.
And to get a real picture, we can't just look at what happened last month. We have to zoom out. So we're going to check in at 3 points: 1 year, 5 years, and the one that really matters for a long-term investor, a full decade.
And what's so cool when you look at the last 10 years is that each portfolio pretty much did exactly what it was designed to do. As you can see, the growth tilt portfolio, it delivered the highest returns, but it was also the wildest ride. And on the flip side, the low volatility one had the smallest drops and was the smoothest journey. But here's the most important part. Despite all the crashes, all the chaos, the long-term trend for every single one of these simple diversified portfolios was up. The big lesson: consistency crushed complexity every single time.
So after all of this, all the models, all the ETFs, what's the single most valuable asset you have for building wealth? Well, it turns out it's not the specific fund you pick.
The real drivers of your success are the principles we've been talking about. Simplicity wins against complexity. Diversification saves you from making huge mistakes. Time is the secret ingredient that just amplifies everything through compounding. And maybe most important of all, your discipline to just stick to the plan is worth way more than trying to predict the future.
And that's really the ultimate takeaway. The ETFs we talked about, they're just the tools. They're amazing tools, but just tools. The real strategy is your discipline to keep investing and not panic sell. And the active ingredient that does all the work for you is time. The most successful investors are often the ones who do the least. It all boils down to this one idea. The goal isn't to perfectly time the market. That's a losing game. The real strategy is simply your time in the market. You set it, you forget it, and you let the magic of compounding do its thing. In our
Bonus, 5-sector ETFs driving long-term growth. If broad market ETFs are the foundation of a portfolio, sector ETFs are the accelerators, focusing on the industries shaping the future of the global economy. Technology is the engine of modern economic growth. VGT tracks the U.S. information technology sector, including software, hardware, and AI leaders. From automation to artificial intelligence, technology drives productivity across the entire global economy. Semiconductors power the digital world. SMH invests in companies that design and manufacture advanced computer chips. From AI to smartphones and data centers, modern technology runs on semiconductors. Cybersecurity protects the digital world. CIBR invests in companies securing data and infrastructure as online threats keep growing. Biotechnology is transforming modern medicine. XBI invests in companies developing next-generation treatments driven by genetic innovation. Clean energy is transforming the global power system. ICLN invests in companies driving the shift to renewable energy. Sector ETFs add targeted growth, but only on top of a diversified core. First own the market, then tilt toward the future. Thanks for watching, and subscribe to learn more about investing.